So when there are material changes to a business, whether because, the market dynamics are changing significantly, or there's a significant change in leadership, or they make a significant M&A that like transitions their business, it's really worth going back and examining the business really hard and seeing if your thesis still holds. And if the thesis changes, is it for the good or, not so good? Because if it does go the wrong way, even though and it's different from the thesis that you bought originally, it's going to make that feel even worse.
Yeah, pay attention to those theses, and if they do change, make sure you up to speed that you're comfortable with that. With that, an analyst or investor is comfortable with that thesis change. And Danny and Tyler, I've I think so many. If you've been around this game and invested for so many years, investing lessons and both painful mistakes and lessons can be very good ones too, like a beneficiary of just some successes that we've had. But I think many of us remember some of the painful lessons and what we learned from them. And for me, when I think of, I've been on both sides, selling too soon and also sticking around far too long, especially from the late 90s when valuations got a little bit excessive, and holding on to businesses that ended up just not even being around and going to zero. But for me, it's that adding to conviction and building out positions. I love to buy lots of different businesses, but really then adding to positions. And I think I look back on some nice big winners that I just did not build positions up as high as I wanted to, or I should have, because the stock started moving higher and higher. I didn't add to those winners, Danny, as you talked about. You like let the winners run. Well, also don't be afraid to add to those ones as they continue to perform well, as long as the valuation is not super excessive and the business is still going well. So it's building out those positions, because those are the ones that really then start having those outsized gains in portfolios, because the compounding effects really add in. And if you look at Stock Advisor, our flagship service started by Tom and David Gardner, those are the ones, the ones we've continued to add to over the years have really had an outstanding level of performance to that outstanding long-term track record at Stock Advisor. So adding, building out, that's just something that I'm trying to really learn, even after doing this for 30 plus years. So y'all want to head over to some questions? We have questions coming in through, again, over our members can put questions into at Fool24 over at Slido. So go right ahead. And team, is there anyone that in particular? David Dudash says, Dan, speaking of investing lessons, Danny, Andy, and Tyler, I bought a ton of OM thinking that it would be a big mover. Then the GLP drugs came out and blew my thesis out of the water. Lesson? Well, Tyler, getting a little bit to if the lessons are changing and competitive threats. I mean, just thinking about a key factor that our rule breaker investing team likes to look at are competitors that are not really thriving or inept. Well, the other side of that is competitors that are really threatening. And if that's a thesis change, that's something to pay attention to. And maybe with Outset Medical OM, the GLPs are starting to be that. And if you recognize that, getting out of that and understanding what might be happening to that business.
Just make sure that I have my mic on. Yeah, that's a really tough one, because it's there's also medical devices, anything that you're getting into this industry where insurance comes into play as the payer for it. It becomes very challenging when you're a new entrant coming into these sort of industries. It can be competitors. It can also be who your customer is, because with a lot of medical devices, not only do you have to pass FDA approval, but you also have to kind of prove yourself to the insurers that what you're doing is worth the insurance risk. And there's a legit possibility that with GLP-1s and some, Outset Medical going into the trying to disrupt the kidney dialysis market, insurance might look at this, because kidney dialysis is a high risk thing, and if it doesn't go right, there's dire consequences. And so insurance companies are going to be very reticent to take on new things in industries like this until it's proven out for a very long time.
Yeah, for specifically for Outset Medical, but really more broadly for like the weight loss industry, for instance, companies like Weight Watchers. We've seen a lot of disruption happen in the industry as a result of these GLP-1 drugs. And I think that this to Tyler's point, you really have to watch these investments closely. At least I have to. And if I see a big disruption happening in the space, like Tyler said, take a step back. Don't be afraid to look and see. And if you think that this is going to be a long-lasting and consistent disruption, then that might change your investing thesis, and it might be time to reconsider your options.
Team, we had a late start to our YouTube feed, so I just want to welcome everyone back who's been watching us and started watching us maybe on YouTube, and just kick us off a little bit again. So I'm Andy Cross, the Chief Investment Officer here at the Motley Fool with Danny Venna and Tyler Crow. Thank you for being here. So this hour on Fool24, we're doing something again that we did before, which is bringing Fool24 to our YouTube audience for the next hour. And here's how this will work. As a Motley Fool member watching this live stream, the experience remains pretty much unchanged. But if you're watching this stream on YouTube, you can view for the next hour. You just can't ask questions or engage with our analysts. If you're curious about where those questions are coming from, they're coming in live from the Motley Fool members around the world over on Fool.com. And if you love the show, and we hope you do, you can be one of those members by gaining access to our services and ask your own question. Just visit Fool.com/invest and you can learn more. Now, a brief important disclaimer: Fool24 is broadcast for educational purposes only, and we cannot provide personalized financial advice. So, Danny Venna, Tyler Crow, Andy Cross here with you for Fool24 for the next, say, 45 minutes or so. Let's get back to the questions, team. Thank you for taking some of those. Let It Ride asked a question that I'll just hop onto, and you all can jump in or take another question. Please rank the following for 5 to 10 year investment at today's valuation: Crocs, Deckers, On Holdings, or Nike. Boy, I'll do my rankings, and if you all want to jump in. By the way, we are talking about some investing lessons that the three of us, and so feel free, please, to put investing lessons you may have learned into our chat over for our members there. I'm going to put Deckers at the top of that list, and then oh boy, I will take. I think I'll go Deckers, On Holdings, Nike, then Crocs. So I'm going to rank Deckers, On Holdings, Nike, then Crocs. I think Nike actually is going to get that ship turned around. I was saying that this morning on the morning show. It's just going to take a little bit of time to get that. And I think what Deckers is doing, and the stock price took a pretty big hit after earnings, so the valuation improved. Any reactions?
I'll take a shot at this, and I'm going to say I have to admit incomplete for Crocs and On Holdings for both of them, because I haven't cracked the 10K on either of those, so
just
I can't
do two.
speak.
Yeah, do Nike.
Yeah, I would
Deckers.
pick Deckers over Nike personally. The one thing that I like particularly about Deckers that they have shown recently is the ability to kind of acquire and nurture the right brands. I know Crocs tried to do that with a couple others. They haven't quite been able to figure out. Nike's tried to go to build a direct to sale, direct to customer sort of option online at the expense of some of its distribution partners, and that has been a challenge for them. So they're trying to right the ship there. But I think of those, I would say Deckers. Although I have to admit, I'm a New Balance runner guy, so none of these actually work for me.
Yeah, and Adidas or Adidas isn't even on there as well too, which is not as much running, but still performance. Danny, any thoughts there, or we can take another question?
Couple of quick thoughts. I don't follow the space as well, but the one stock that stands out to me in that group is Deckers. I actually went and looked really quickly, and for investors that are price sensitive, this may not be the best investment, because Deckers is they have a tendency for their valuation to be high. Now, right at the moment, it's actually pretty reasonable. They've got a forward price to earnings ratio of 27, which is not terrible in my estimation. And I think one of the things that you see is if you look at the stock chart, it's actually the stock has more than doubled over the past in a couple of years. And I think that's a testament to exactly what you heard our panelists talking about. And that's the fact that they've been able to focus on the brands that have the best potential. And have been able to nurture those and grow those. And rather than having too many brands all over the place, and not really paying much attention to any of them, I think their strategy has been pretty successful. So I won't rank the other three because I don't follow them well enough. But of the four, Deckers is the one that stands out for me. I did see one question in here that I wanted to address. This question came in from Ed about 14 minutes ago. And he asked, what are some interesting global stocks that stand out besides ASML, Grab, Coupang, ticker CPNG, Mercado Libre, ticker MELI, and Shopify, ticker SHOP. I like this question because I actually own three of the five stocks that Ed mentioned. And actually, if I go and look at my portfolio, I can tell you that Shopify is in my top 10 and Mercado Libre is in my top 3. And I'm a big fan of Mercado Libre, as longtime fools will know. It's a stock that I looked at 2009 and thought, well, wait, this company has been called the Amazon of Latin America. It's been called the PayPal of Latin America. It's been called the Shopify of Latin America. They have twice the addressable market in the region as their competitors have in the United States. And we're growing like a weed. So that's one of those companies that Andy talked about that I added to numerous times over the years, and I'm still a big fan of that. Now, outside of that, I think a company that has a lot of opportunity and just has not yet been able to translate that opportunity into stock price games is a company called Global E Online. Now, Global E Online, if it's a company you're not familiar with, ticker GLBE, and this company specializes in helping e-commerce providers go into new markets. So they offer services like currency translation and regulatory issues and payment methods, and that way, the e-commerce provider can focus on selling their goods and services, and Global E Online can handle all of the issues because it's very complex trying to sell your goods and services in a new country. There might be trade barriers. There might be currency, as I said, currency issues. And so I think this company has a great opportunity. They are used by Shopify to help Shopify users move their goods and services cross country lines. So I think there's a lot of opportunity there. They haven't translated that into a good stock price, but certainly one that I own a small piece of it, and it's one that I'm watching very closely. Perhaps one of you gents has a global stock that you're interested in.
Tyler, you want to take any, or I can jump?
Actually, we can, because I can answer a question in the queue while answering this question at the same time.
Nice.
Because SB asked me about TBBB, the ticker, which is BBB Foods. and this would be the outside America pick that I would have. BBB Foods is a Mexican hard discount grocery company. So the a concept of the hard discount, if you've ever been to like grocery outlet bargain market or an Aldi or a Lidl or something like that, not a lot of plate presentation, pallets on the floor, kind of that, trying to get the lowest price possible by not no frills. You know what I mean? And this business went public last year. And what happened is it's a great story. The CEO, Anthony Hatum, was a equity analyst, I think at like Morgan Stanley or something like that, and was tasked at following hard discount grocers across Europe and Turkey and a lot of other places, and just kind of fell in love with the business model and did a white paper search of like what was the most underpenetrated market for this. And he discovered Mexico, moved his family down there, and like did a lot of boots on the ground research before starting this business. And kind of took this model of taking this hard discount model, a lot of like private label sort of businesses, products on the shelves to keep costs down. Also, there's a lot of it that you read the prospectus on like all the customer research. Like we need our stores to have a certain footprint within neighborhoods because people are going to come 2 to 3 days a week because they don't have cars. They're going to walk, and like they fit their packaging to that size. All their like SKUs or store keeping units specifically to this. It was like reading a passion letter of hard discount groceries, and it's like the business itself has been taking off, like growing like wildfire. Same store sales have been double digits for 10 years. And it's a business that's been looking to do, they have about 2,600 stores across Mexico right now. And their white paper analysis when they went public says they can do up to 20,000 stores. So we're looking at a pretty significant growth in terms of total store count, as well as, it looks like it's pretty popular with its customers if you look at its same store sales. And so with this, that outside the United States is one of my favorite kind of like international stocks. And it's probably one of my larger holdings right now because I'm really on board with what they're going to do. And then to SB's question about it being, expensive, and, I might take a little contest with him saying it isn't a first mover or top dog in the category. This was a pretty underpenetrated segment in Mexico relatively. Yes, there's a lot of like hard discount, like mom and pop stores, but there's not a lot of, national chains that have, taken this and used scale and distribution and private label in the way that they're doing. So I might push back a little bit on that, but the reason that I'm so attracted to it, despite its very, very high valuation, is I think the potential growth that it has. And I think this might be a little lesson on valuation, because when you have a company that, only has like maybe 1 or 2 cents per share in earnings, or, earnings are very, very low because it's very early in its stage, or maybe it's a cyclical company that had like it's on a down cycle and its earnings are very, very low. Price to earnings has this weird curve. It's like it starts really, really high and then it starts to flatten out over time. It's called an asymptotic curve for all you math nerds out there. And so when your earnings are really, really small, it's like going to infinity. And so like anything over 100 to like 5,000, it's kind of like not that far off. Price to earnings is much more effective as a measurement of like valuation for a little bit more mature businesses with, predictable cash flows, predictable earnings, and honestly quite a bit of it, such that when you start to get into like the earnings, price to earnings ranges of like less than 100 down, it starts to become a little bit more of a meaningful representation of valuation.
Yeah, you see that a lot with tech companies because they're not profitable, or young tech companies tend not to be profitable. For free cash flow, they add back a lot of non-cash charges, but they tend not to be profitable. So the PE ratios are either negative, or once they start crossing that profitability curve line, the PE looks really inflated very high. But like you were saying, Tyler, because the earnings have yet to catch up to the business, and they don't always do that. But when they do, and I've talked about this recently, starting to find those inflection points, Those are some of my favorite investments. I think about a company like Axon Enterprise went through that too, and you can really find some really healthy ones to grow. From the international side, I like Globant, GLOB. Danny, that's where I thought you were going to go, but this is a different globe company. Globant, digital consultant, GLOB, provides a ton of insights, guidance, education, training, development, software, talent to multinationals across the world. Disney is a large customer of theirs, has been a large sticky customer for many years. They are forefront of utilizing AI. Founder led. The founders are still involved in the business, although they don't own a ton of stock. It's run out of Latin America, but their large clients are in the U.S. and really all over the globe. But the way they structure their engineers and their talent into different pods to be able to provide those resources, those digital consulting resources that just companies need as we increase not just AI spending, but really cloud architecture, anything security. The need for education and talent is going to be, I still continue to be a healthy spot in the market for corporate investment, enterprise investment. And so a company like Globant, GLOB, which is kind of like a mid-cap large company. So still lots of room to grow for that one. So I like that because it is a global enterprise.
I did see a question in here that I think is a pretty interesting one, and this is one of the ones, Tyler will appreciate this, that I can take one of these, take this question and pivot into another one. And Richard O asks, what are your most important lessons in international investing? And I think that's such a great question because, investing internationally is such an important part of building out a balanced portfolio. Some people are not comfortable investing in international markets and global stocks, and they may be doing themselves a disservice. To me, one of the most important investing lessons that I learned is how difficult it is to invest in stocks in China. And that's because, the country and a lot of the industries are so highly regulated by the Chinese government. And essentially, if you are a company in China and the government tells you you must do something, you have no choice but to comply. And so at any point, you can have a stock that may be doing well in China, and then all of a sudden, if the company or one of the executives falls out of favor or is not following instructions given to it by the Chinese government, that can adversely affect your investment. There are also, different regulatory criteria in China, and anyone who had experienced Luckin Coffee, for example, knows just how challenging investing in Chinese stocks can be. I do still have a couple of stocks in China, one of which is Baidu, ticker BIDU, which is been called the Google of China. They're the largest search provider in the country, and they have fairly dependable revenue streams. But again, this has been a challenging stock to own because there's been a lot of ups and downs there. Now, one of the other questions, a viewer asks, and I'm having difficulty finding it now, but asked about, how would you go about investing in technology and AI in China? And I think that basically that highlights that. Here, I found it. That's from Jimbo has a question. How would you invest in Chinese AI and tech? And I think with the same mindset, keep in mind that investing in companies from China may be a little bit more challenging. It may carry a little more risk than investing in companies in the United States. There's a different regulatory environment. There's the chance of government intervention, let's say. So, I would make sure that any investment in China is either with a very large, well-known, and easy to follow company, or a very small investment with that's assigned to the riskiest part of your portfolio. Any thoughts, guys?
Tyler?
Specifically on Chinese and AI, not really, but I'll get back to the international
Same with
investing.
me. Yep.
I think we've had this discussion previously, Andy, but investing internationally, especially companies that aren't listed on the US exchanges, how much of a deep longing I have for the SEC website and all of the public disclosures that are available to US investors. One of the things that is definitely more challenging when you start to make investments outside the United States, especially companies that don't list shares in the United States, it can be a little bit harder to get the same type of disclosures that you have for the business, for their earnings reports and things like that, proxy statements as well, talking about management and the board and their incentives. So it takes a little bit more digging. Sometimes it can be much more challenging to find all the information that you want. Sometimes you have to go without some of that information, which is unfortunate. So one of the things I would say is to international investing is it just requires a bit more homework than I think the just pulling up Edgar and pulling all the filings I ever need for the rest of my life.
And there's ways to invest in international stocks that are listed on U.S. exchanges. And Danny, I
Yeah.
mentioned a few, and Tyler, we talked about a few. I think that trades on the
BBB
U.S.
Foods. Yep.
Yeah, BBB
Yep.
Foods trades on one of the U.S. exchanges, right? So there's
Yep.
ways to do that, which then helps with they file 20Fs, not 10Ks, but still the filing restrictions are a little bit better. And then you're talking about investing, like Tyler was saying, investing on companies in other exchanges. It's a lot more difficult, often expensive, sometimes expensive for U.S. investors to do that, and not always the shares are available. I really have not dabbled much out there, guys. I stick mostly to the U.S. stocks, certainly U.S. listed stocks, but mostly just U.S. stocks, considering so much innovation and so much opportunity has been in the U.S. markets. And of course, as many of us know, just overall those markets globally, not always, but have just not really competed with so many so much of the U.S. as competed as well as the indices in the U.S. over the last, say, 10 years. And international has really dragged. Doesn't mean that it's not going to change, but I think there's been so much opportunity in the U.S. So that's really been my place that I've spent most, if not all, of my capital invested over the last 30 years.
I'll take this one because Jimbo has a question. He asked it 12 minutes ago. And if I look deeper into the queue, it looks like he's asked a couple times in previous days. So I think he's really itching for an answer here. So I'll try to take it. Jimbo asked, what do you make of A-Lab quarterly report, the ticker A-Lab, opportunity to buy or too risky? A-Lab is the ticker for Astera Labs. Astera Labs is a company that it's a component company very much tied to the semiconductor industry. They have a product called I don't know how it's pronounced. It's either retimer or retimer. I'm not sure which one it is, but it's a way of basically kind of amplifying signals for data packages, either in semiconductors or translating that from the semiconductor to other components within a circuit board, motherboard, whatever you want to say. It's a very novel concept. They seem to be getting a lot of traction with the big semiconductor manufacturers. NVIDIA, Intel, and AMD are its three largest customers. All three, they think it's like 70% of their revenue. The quarterly report looks fantastic. Growth has been monumental. It seems like they're getting a lot of traction with these products, selling them into NVIDIA. The benefits of them, as they've said, it kind of like helps to reduce variability on latency for communication. So when you're looking at very high performance chips, especially related to AI, this is kind of an interesting business. So my biggest takeaway from this business is I think the earnings looked great. I think the guidance looks pretty good. The valuation is a nosebleed, would be putting it lightly. And I would say the two risks for this company is when you're tied that much to, two or three companies, which, if I wanted to be tied to a company for my prospects, NVIDIA, AMD, Intel, those are pretty good customers to have. But you're also going to kind of wax and wane with the cycles of the semiconductor industry. And at the same time, as you know, there's patents and technologies, but if a competitor were to come into this space and offer a competing either better or, you know, cheaper product, I would not be shocked if, you know, it's you know, the vendors or customers decide to go with someone else that might eat into market share. So you're kind of like riding the tailwinds of semiconductors and the possible risk of technology disruption. Right now, it's a really good position, but for the company specifically to be in. But it certainly feels like one of those ones where it's like things could change very, very rapidly.
Richard O has just a comment. Cash provides a valuable emotional ballast when you have 80 to 90% stock allocation. So getting back to some of the investing lessons, and that's true, Richard. I think that's, you know, and for many years of the last, you know, 7 years, cash really did not earn a lot. In fact, even in some of my accounts, the sweeps accounts, they still doesn't earn very much. But now it does. So it earns a little bit, and it gives a little bit of a ballast and a little bit of comfort knowing that if prices are volatile, especially moving down, and you want to allocate, or somebody wants to allocate capital at different points without having to liquidate some holdings they may not want to liquidate, there's cash on the sidelines. So yes, so cash can provide that balance. It can also be a drag though when stocks are moving higher, if someone cares about beating the market as opposed to just making money. So just something to pay attention to. And I personally am trying not to get too cute with my cash allocation strategies. It's much more sticking on as best a rhythm as I can every few months, every month, trying to allocate some capital.
You know, there's a really great question here that I think maybe we can all provide a little bit of maybe our opinion on. And this is from Jimbo has a question. I hear from some that this is one of my largest holdings, and I continue to listen, and the same person will make that comment on many of the stocks. Diversification. And I want to start off with me. You know, I have a portfolio that is not a construction that I would recommend to others. And the reason for that is, you know, my top, say, 5 or 6 holdings represent about 50% of my portfolio. I haven't looked, so I can't tell you the exact number, and it changes from day to day. But on the topic of diversification, you know, I have a lot of smaller positions in stocks that maybe I'm watching, or that maybe I thought had potential and it didn't turn out to be so. And I'm not so quick to sell. I might hold the stock for 5 years or longer, even if it's not performing. And then at some point I might go out and just bulk sell a bunch of smaller positions in stocks that, you know, I no longer have confidence in. But specifically on the topic of diversification, if you look at my portfolio is extremely tech heavy. So you're going to see a lot of technology stocks. You're going to see a lot of chip stocks. You're going to see a lot of cloud stocks. You'll see a lot of streaming. And one of the things when I look at this and people say, well, what about diversification? You're all tech. That's a fair question. But if you look at the companies that are in there, I am diversified within industries. So, you know, Amazon, as a for instance, Amazon does e-commerce, it does cloud computing, it does digital advertising. I own a big piece of Meta. Meta is, you know, social media and also digital advertising. I own NVIDIA, which is a big chip stock, but it has ties to the AI industry. And I could do this over and over again, but my point is that within this heavy technology concentration in my portfolio, what you see is diversification along industries, diversification along the size of some of the companies, diversification in terms of opportunities or markets. So there are other ways to diversify. And this one just works for me, but I'd be curious to hear, what my co-hosts think about this topic.
It's kind of, I mean, yeah, I maybe it's a little bit of a misnomer to say it's one of my largest holdings when it's maybe like 4%, 5% of my total portfolio, because, I have probably 70, 75% of my invested wealth in publicly traded stuff. And then on top of that, I have 40 or so publicly traded companies in that publicly traded component of my portfolio. So yes, it can be one of my largest holdings, but if I have like 15 of them that are all between 3 and 4%, it might be a little bit of a misnomer. And I hope that doesn't like over extenuate the how much I think about this company, because I do, you have to think about it in terms of, diversification too, because yes, I want to make a bet in something that I have conviction in, or make an investment in a business that I think is going to do well, but I'm not going to put an amount of money that could like financially compromise me based on my entire net worth.
I also run multiple portfolios. And so sometimes I'm thinking like, oh, in my taxable account, in my non-taxable account, in my kids' accounts, it's a big position. So I sometimes confuse those. So sorry, Jimbo, or whoever asked the question, if providing some guilt there. But Home Depot, the Berkshire Hathaway, Nvidia, those are some of my those. I think those are my three largest positions. From a diversification, Danny, perspective, I like to use ETFs to get that broad diversification. So I'll buy things like maybe the equal weight index to offset some of my weight into tech companies, or even into my 401k is heavy into some of the wide market funds that we have available in our 401k provider. Or I may go to a value ETF to help offset some of the growth in my portfolio. So I'll use ETFs and cash to kind of balance out some of those factors, because overall, most of where I am investing tends to be a little bit more on the, I would say, GARP to growth side over the last, say, 5 years. But I am more recently trying to slide a little bit more towards looking at some of those ones that are, maybe earlier in my career, I would classify more as value-based kind of opportunities. Ones that are, especially if they've just been a little bit ignored in the marketplace, or forgotten about, or sold off and discounted, or ones that just people weren't really respecting as much. So companies like recently, last year, I would say a company like DocuSign, Doximity are also two Docs companies, DocuSign, Doximity, PayPal, that I had invested in.
Since this question was directed at me, I'll answer it really quickly. But Richard O asked, Danny, what do you do with your Netflix profits? Well, actually, Netflix is still my largest holding right now. Now, I have to say that over the past few months, sometimes there's a changing of the guard. Sometimes Nvidia is my largest position. Sometimes Netflix is my largest position. Right now, Netflix is the leader at about 14% of my portfolio. And again, I tend to let my winners run, and I add around them. Some folks might not be comfortable with one stock making up 14% of their holdings. I'm okay with that, because this is the stock that I have covered the longest, and I've owned since 2007, so I've got a long history with. And I don't really have much in the way of Netflix profits because I rarely sell. Now, there have been a couple occasions over the past few years where I wanted to raise cash for personal reasons. And in those times, I took kind of a mixed approach. I trimmed off a little bit of my Netflix position, brought it down by about 1% of my total portfolio. And I also sold off a bunch, like I was talking about earlier, sold off a bunch of my smaller positions that I didn't have a lot of conviction in anymore. So yeah, I think what I will do with my Netflix profits once I sell off a bunch of it is probably fund my retirement.
Hey, that's why we invest. We invest to ultimately use that money in some way, donate it, use it for retirement, use it for a reason. And so that's why when people are selling, there's lots of reasons people sell, executive including diversification, other reasons. Pretty much there's one reason why someone buys, and that's with the expectation that the stock's going to go higher. Phil asked a question, team, that, oh, sorry, Tyler, were you going to jump in with a question?
No,
I was
go
going to
ahead.
talk about Phil's high school students one. That might be a little bit long
Sure.
if you all want to take specifically. Maybe we can get to Phil's as we kind of get closer to the hour, because that's a little bit more educational. Maybe we can hop through any ones that are maybe more company specific.
Sure. I'll hit this one. It should be pretty quick. Sadaf asked 11 minutes ago. I noticed it's not company specific, but he says, I noticed some of the non-US companies are traded on the OTC. It's also called the pink sheets. What is your perspective of investing in those companies? I think that really, it depends. What happens is when a company is traded on the OTCs or the pink sheets, basically what it means is that the company doesn't raise any capital in the US, either through debt or equity. They're doing it all in their home market. And probably some intermediary is providing an opportunity to buy an assimile of the stock on the pink sheets. Examples: Volkswagen is traded on the pink on the OTC market. So is Volkswagen. A lot of other I think is LVMH an OTC, or do they have a US listing as well? I can't remember.
They probably have an OTC. They probably have an OTC. It just depends on liquidity, but I don't know. I'll check it. While you keep talking, I'll check it out.
Right. So it can be a very broad idea of like investing in companies that are on the OTC, because you could be investing in multi-billion-dollar luxury brands like LVMH or Nestle, consumer staples, or you could be in, small companies, startups or something like that. So it can be in my opinion, it's much more about the company itself. And when you get into the big companies like a Nestle or a Volkswagen, they have lots of disclosures, a lot of information that can be provided publicly, probably a lot of analysts that are following it, and you can probably get the adequate information. The liquidity component of it, if you're moving in and out of companies, that can be a little bit more challenging because they're typically a much more illiquid position. But if you are looking to own these businesses for a very, very long time, maybe liquidity doesn't quite matter as much.
Yeah, LVMH has an OTC that's very liquid. Nestle has one. So these are large companies that choose not to list on US exchanges, as Tyler was saying. There are some smaller international companies that do have primary listings on their home market, and they have OTC or pink sheets that might only trade, if some don't trade at all. Some may trade 100 or a few shares per day. So just be cautious around there. If you're, and we talk about this in our international services, we talk about which security we guide people to pay attention to, whether it's the ones that are listed on the pink sheets or the OTC or listed in the home markets. Tyler?
Yeah, I was going to say, often now, I think with a lot of brokerages, you can buy the stock that's listed on the foreign exchange. Sometimes it might involve not just a mouse click, it might involve a phone call. I know I've had plenty of those with Fidelity, but it's certainly an option, and most of your platforms or brokerages are able to do that. So if you're not sure about a very illiquid pink sheet, but the foreign listing is available in your brokerage, sometimes it's just easier to do it that way.
And just quickly, for our viewers who may not be familiar with that abbreviation, OTC, that stands for over the counter.
Sorry.
Which, no, I remember a day when I heard somebody say that, and I was like, "What is he talking about?"
Have you all ever seen real pink sheets? The real pink sheet books. When I first started, they used to have these books that were like a flip book, and they were actually the listings, and they were pink. like the Financial Times, they were pink, hence the term pink sheets when
And
you would
that's how it
flip
got
through those,
its name.
try to find the security. We have about,
Nice
let's see,
history lesson.
7 minutes to the top of the hour. So let's just go through this. Anyone's Jimbo has a question asked about MedPace, MEDP. Boy, it's been disappointing over the past few months. That's a contract research organization, and it's a high quality, been around for years. The challenge with MedPace is their clients depend on funding, especially their smaller biotech companies, to fund the studies that MedPace helps run in their businesses. And if funding with higher interest rates for longer, maybe that's putting a stress onto their ability to fund research. And so MedPace has talked the past few months, past 2 quarters or so, that's a struggle. So their book to bill, a measurement of how much business that they're bringing in relative to what they can recognize, has started to drop. And so we're looking for that to increase. They reported earnings today. I have not had a chance to digest them. They're on my list. It is a good quality small mid cap growth business, founder run, but it is facing some of those more market challenges right now, as many pharmaceutical companies are.
I remember right. MedPace's CEO is quite old, isn't he?
August Trundle. Yeah, I mean, not like Buffett old, I don't think.
No, not Buffett old, but
nothing
that's
against Mr. Buffett, but I think, yes,
yeah.
he is elevated
Just
in age.
I was thinking of it in the terms of like maybe succession stuff like that. But
Yes.
to continue the idea of contract research organizations, MedPace is not alone in the underperformance. Stock's down
Yes.
quite a bit. If you look across contract research organizations over the past year, almost all of them are down. I was just looking it up. Thermo Fisher Scientific is down
Yeah.
over the past year. Same with IQVIA and Icon. So it's a pretty recurring theme across the entire industry.
Yeah.
So I see a question here from David Dudash from about 27 minutes ago. And David asks, is DLO similar to GLBE? And that's a good question. DLO is a company called D Local Limited, and they are primarily a payment processing platform worldwide. So they primarily focus on payment methods, whereas globally online, they actually do cover payment methods, and so there is some overlap. But globally also handles a lot of other things. One of the ones that comes to mind is like customs and duties. If you're selling an item and you're selling this into a country where that item might have a custom or a duty or a tariff, what they do is they handle the knowledge base there. And if you say, well, I want to sell this in this country, they say, okay, well, here are the challenges. Here are the criteria that you need to meet in order to do that. So it's customs and it's duties and it's payment methods and many other things that are involved. So there is a little bit of overlap between DLocal and globally online, but only in so far as it has to do with payments.
I'll hit one more too, one here because it was asked for me specifically. I'll Take Lucky asked, Tyler, any thoughts on Albemarle? Is there signs of the lithium market turning? Well, I kind of gives it away. What Albemarle does is they are a miner of lithium, as well as some other things like bromides and for making specialty chemicals and things like that. It tend to be products that come together at the same time when you're mining for lithium. As the question kind of insinuates, the lithium mining, the price of lithium is pretty much going to dictate whatever happens with this business. And lithium prices have been very volatile over the past couple of years, and as a result, so has Albemarle's results. This over the past 12 months, revenue is down 34% compared to the prior year. So this is an industry that is more or less going to wax and wane with lithium prices. When you're looking at lithium so far, I mean, we do have some production of EV batteries and things like that in the United States. But if you look at, global production, much like many other commodities, whatever is happening in China is going to largely dictate what happens with lithium pricing. And so there was during 2022, there was some very large like inventory builds in China to add lithium into inventory so they could turn it into lithium ion batteries. When the business of selling EVs has kind of slowed down, we've seen it in the United States, sales are kind of flattening out a little bit across the EV space. As a result, all those inventories just meant that, Chinese companies that were making the batteries have been just kind of using up inventory rather than making significant orders. And as a result, we've just seen lithium prices go down significantly over the past, was it from September 22 to September 2024, which is the most recent lithium pricing data that I could find. Lithium hydroxide and lithium carbonate prices that were sent to Chinese ports at the pricing at Chinese ports was down 80%. And so it gives you an idea of like kind of the wild ups and downs that you can get in this industry. And it's definitely one of those industries as a cyclical mining commodity. When everybody's talking about like, oh my God, we don't have enough lithium and it's euphoria and stocks are incredibly valued and all the mining companies are talking about, the 15 mines that they're going to bring on in the next few years, that tends to be the time that you do not want to be buying lithium stocks because, that once all of that supply comes online, all of a sudden the market gets oversupplied pretty quick and prices drop and you get into a situation like this. When you're in these points of low pricing, if you can find a good business, I don't know if I would say buy it immediately, but certainly watch it. Going back to my early investing lesson with like Transocean, just because you pick the right one doesn't necessarily mean it's a great decision in the moment. But find the best investments in the industry. And, sometimes it's just good to sit. I know there's a lot of companies I've sat and looked at them for 7 years before I've even decided to make an investment. And it's hard to display that kind of patience, but sometimes you have to, especially with cyclical industries.
Yeah, exactly. Tyler, you have to understand how the market, those cycles go. And sometimes it's painful to watch those cycles go up, but the flip side is they sometimes come down, and then you have to wait for them to turn on the other side too. I wanted to take Phil's question. Any recommendations for high school students who want to start investing? Online programs, books. We are at the top of the hour, so we're gonna have to wrap things up. I just always go back to the classics. Peter Lynch, One Up on Wall Street, I think is just a really great spot to go. Tyler, I don't know if you have any go-to, but that's where I tend to point people first. There's loads of information.
I don't know if high schoolers will want to read this one.
Well, I don't even know if high schoolers
it's a little dense.
Do they read books anymore? But I guess you can find these all online these days. But I just think One Up on Wall Street, that book was instrumental. In fact, I have notes from my father who gave it to me, and even his signature in here. Not Peter Lynch's, my father's. Who was so instrumental in helping me start to invest. So I think there is so much great information out there, especially now. There are blogs, there's Motley Fool at our services, fool.com. Stock Advisors, a great introductory service to get people just focus on understanding investing. But for me, Tyler, it comes down to really trying to think like a business owner, understanding that businesses exist to drive revenues and profits that are used to drive further revenues and profits for shareholders, not for trading. Because when I do talk to teenagers or younger people, it is so much more of a trading mentality, thinking about a stock. Even my young kids, when they see the tickers go up and down, either on the website of the Motley Fool maybe, or my stock tickers or CNBC, whatever, they just always talk about, hey, how did Apple do today? And I'm like, well, it's not really so much about today. It's much more about, the next few years and what are they doing to innovate, how are they growing, and how are they driving those revenues. So that's the lesson that I want to make sure younger people really appreciate and understand. So I don't know if you all have any quick ones, and then we can wrap things up here in Motley Fool 24. I
I'll
don't
just
even
give
know
the
who we
quick
have
one.
come. Oh, Tyler, go ahead.
My quick one is read lots of different perspectives. The perspective that you get in Benjamin Graham's The Intelligent Investor is wildly different from what you get in Peter Lynch. It's wildly different from what you get from Philip Fisher's Common Stocks and Uncommon Profits. They all have very, very different messages and different approaches. And I think it's very valuable to look at all of them and find what reverberates with you and pick some from here, pick some from there, and kind of shape your own, because these were successful at a certain time. Maybe some of the lessons aren't 100% relevant, but you can take lessons from everyone over time and apply them in different places.
100%. Danny, are you sticking around?
I am sticking around, and Travis is going to be joining us. But while they're bringing Travis on, and this might sound a little self-serving, but I found that the Motley Fool provided me with some of the best investing education that I could get. I was actually a subscriber well before I hung out my shingle here, and honestly, I can't say enough about the experience of being a member. And the lessons that it taught, and it actually led me to where I am today.
Well, that's awesome. Danny Venna and Tyler Crow, thank you for joining me. And that's going to wrap it for today's Fool24 YouTube hour. Thanks to all of you for being here with us. We hope you enjoyed it, and we hope you found it valuable. If you're tuning in from our YouTube audience and want to ask a question of our investors, well, head on over to fool.com/invest and join the Motley Fool as a member. That's fool.com/invest. And if you're a Motley Fool premium member, stick around, because we got another great hour of Q&A with Danny and with Travis joining us here soon. So thank you, Fools, Tyler and Danny. Thank you for being with me here on Fool24 and Fools. We hope you enjoyed it. And Travis will hop on and Danny will take it away. And Danny, maybe you can continue with some of those great questions, because we have a lot of good ones in there. So many good ones. So you and Travis will have I think,